Hey folks, Dan Frio here with your closing bell for October 23rd, 2024. So mortgage rates continued their uptick. We're this close to 7%. Are we going to get there? It's probably looking that way by Friday. So let's get to the news that we have so far. 10-year Treasury yields rising on potential red wave election results that are pushing up yields. So today, some of the markets saying, it's because a red wave might be coming. This is just posted, what is today? Today's the 23rd. So let's go down through here to see what it says. And it says, while the bulk of the move can be attributed to pretty strong economic data, which we know that it's strong, over the past month and a half, election concerns also have come into play. Okay, what's in the play? Solid economic data repriced the bond market because it forced investors to dial back significant rate cut expectations. But higher bond yields also now reflect a bit more potential for a Republican basically wave of the sweep of the election. So that's what we're seeing on that part of the equation. Go over to here, and home sales are just getting pummeled. Now, prices aren't going down, but the crash is occurring right through here. There are no homes selling, okay? The housing inventory needs to ramp up. We need inventory, but we also need rates to come down just a tad to make things a little more affordable, because it is true. As soon as rates hit like 5.9 to 6%, our phones go crazy. Right now, it's like a Morgan here, I'll be honest with you. So kind of scary moments right now because mortgage rates are, I think they're on the forefront of things, and the political campaign right now it's concerning. So I'm not going to get into the political atmosphere with things, but the deficit is one of the biggest things that's coming into play right now. So let's get over to the broader markets. The equity markets right now, there is red across the board. And unfortunately, there's red across the board all over the world. Let's go to Europe. Europe, down, 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 and down. We go to Asia, down, down, and down, or unchanged. A couple little things over here. The bond market's, it's up again because we know bonds are starting to rally. Oil, it's staying right in there between the $70 and $72 a barrel that we're seeing there. Gold actually had a reversal today, a little bit of a gold reversal. Gold glitters as U.S. election nerves grow. Stronger dollar dents stock. So a strong dollar right now is behind a lot of this as well. The MBS market is taking it on the chin. MBSs are down 27. That's been baked in. It looks like pretty much baked in so far. Let's refresh this for our final reading of the day. So final readings right now on the 30-year fix is 6.92. So we go over to this section through here. The good news, well, I'll say it might be a little bit good news. We have another former Fed official talking right through here. And at least her words are a little calming, because you have a lot of people down through, they're saying, Fed's not going to cut anymore, and the Fed, they did a mistake and all this other stuff. We can't look in the past. Let's look in the future. So let's see what she has to say with it. She is a former Fed official. That's why I take her comments a little bit more with certainty than a lot of the others. So let's see what she has to say.
We were just discussing this idea that, rates have continued to climb despite the cuts. And what does a Jay Powell make of that and think about that?
Well, good morning. I think this is a very unusual time when the Fed is cutting rates, and this is not a weakening economy. I think part of what we're seeing in these longer term rates is the fact that markets are adjusting to the expectations that they've had for some time about the path of interest rates. And I think beginning to take note of the fact that we are financing some pretty big deficits as we go forward, with really no end in sight at this point.
And so when you get to a November post-election, if you were on this board, what would you be telling Jay Powell to do?
So the Fed has taken a big cut already. And I think my inclination would be to proceed with caution here. Clearly, this is a committee that must commit to a forecast. They can't really, although they say they go meeting by meeting, you really are laying out a forecast. The most recent data appears to have been stronger than the level of confidence you had going into that big rate cut. But I think the Fed will have to follow through on its forecast until it sees a little more clarity around how the economy is unfolding, and in particular, the path of inflation.
She made a great point there, because the Federal Reserve, they keep coming out and saying, well, it just depends on next week's report. So nobody can really get a gauge on, well, what are you going to do? For example, we have an unemployment report coming out tomorrow. If it's completely dismal, does that mean, the Fed's back on track where they can cut rates and you'll see rates plummet? Well, then the flip side of that is the federal deficit. It's so high that, could it be, because it's so high, are investors looking to buy into the mortgage market again to bring down those rates? So let's see if she has anything to say about that.
Do you think it was a mistake to cut as much as they did in September?
So I don't think you can say it's a mistake yet. Certainly history will give us a chance to do that. But in the scheme of...
It's kind of crazy if you look at this. Here's over the last meetings that they had, they were up 25, pause up 25, and then pause, and then down 50. I was against the 50, but they were saying they were playing catch up from the month before, so they were expected to do 25 and 25. So there's a lot of pauses in there, and then that big jump there. That's kind of like I would say, Sesame Street. Remember Sesame Street, where if you're looking at this, it's like one number just doesn't fit. Well, they actually highlighted it in yellow. So that's my take on that.
Of their current rate cycle. Again, I think you have to give this time to play out. And what will matter going forward is the path and how much further they go with that.
So how strong do you think this economy is? I mean, that's fundamentally the question, not just in terms of the growth piece of it, but also the labor piece of it.
I think the economy looks pretty good, Andrew. When you look at the outlook for growth, when you look at the labor market, and again, we've seen it come off an historically tight level of job market to now coming into better balance at the same time that inflation's come down. Those are all good indicators for the economy. That doesn't mean that the path ahead isn't going to be challenging, though.
Let me ask you.
It was also interesting last week. I don't know if you guys saw it, but Amazon, they're requiring their corporate workers to actually go back to the office. And if you don't want to go back, see ya. So a lot of times, back a year ago, 2 years ago, 3 years ago, people couldn't find people to work. Now people need work. Okay, so the companies, I think the power is swinging back to the companies a little bit, which might be needed to bring people back to work. And you might say, well, I'm as productive as I am in the office. Well, I have a whole staff of people too, and I can honestly say, the people that work from home, are they as productive or more productive than the people that come to the office? That's up for debate. So that's another piece of this equation where it might help the corporate real estate world if a lot more employers come back and say, guys, we're the employers, you're the employee. We have the ability to make rules for you. If you want to work here, here's the rules. And maybe take back the wagging of the tail instead of the tail wagging the dog. Just a thought there.
If we can ask it in a just apolitical way, but I know we have 13 days to an election. Why do you think what do you attribute the economy's strength to?
Well, I think you have to say that the economy is really operating off a combination of the Federal Reserve and the federal government taking massive actions during the pandemic. We have seen a tremendous amount of fiscal money come into the economy, and that is still there. You have seen the Federal Reserve with a large balance sheet, low interest rates, and that combination at a time when supply chains were backed up allowed inflation to get a foothold in the economy. So now you see things backing off.
But so when you look at all of the fiscal spending, do you say, that was inflationary and that was a very bad decision? Or do you think that was a good decision, okay decision? How do you think about it? We were talking about Paul Tudor Jones was on our broadcast yesterday, and he said, eventually, the only real answer to our problems here in the U.S. are going to be to inflate away our problems.
Yeah, I think you have to say in the short term, many of these decisions are good, right? When you're trying to provide relief to the economy. Policymakers, however, have to look to the long run. And the long run is not a pretty picture when it comes to our fiscal situation. And so the outlook is more inflationary. There is more upside risk there, and it will put tremendous pressure on the Federal Reserve as an independent central bank to decide how it's going to respond to what lies ahead.
That was my question. How much do you think ultimately, we talk about the different mandates that the Fed has, When it comes to our debt and deficit and just how much we're going to be spending over time, how much do you think that's going to get calculated into the larger scheme of things?
I think it has to get factored into that. It has to get factored in this way. You have to look at the path of inflation and understand where there are upside risk. What should the Federal Reserve be doing to manage that potential risk? And that's why I think they will have to be more gradual and cautious in looking at the path of interest rates ahead. It doesn't mean there's not going to be further cuts, but I think the resting point for those interest rates could well be higher than originally imagined.
Esther, China notwithstanding, we have led the world in the way our economy operates. And I guess I'm talking about Europe, versus Europe or South America. And I think 40% higher GDP average over the last 40 or 50 years. So we do have an economy that's the envy of the world. Are we at risk? And we've been talking about whether we want to get up to France's 52% they're much higher overall tax rates, much more regulation, much more of a social safety net. We're down at, I think, 29% for taxes. Are we at risk of losing that preeminent status?
Well, I think you always have to keep in mind what are the factors that led us to be such a great economy and the envy of the world. And that has not come by accident. It's come by a combination of things, our capital markets, our rule of law, but also responsible federal spending. And right now, that spending does not look responsible. In fact, it looks like over the long run, it could undermine many of those advantages that have made us a great economy. Right. And that's why I think it's well worth policymakers' time to really zero in on this issue among many they have to think about.
So I hope you watched the entirety of that video, because here's my analogy. And this is, again, I go back to my student loan issues. The government right now is just dangling carrots in front of everybody. Think of maybe your parents sitting there and they just bribe you. Hey, if you do this, I'll buy you a new car. If you do this, I'll do this. But they never paid for anything. And then you found out years later, it's like, oh man, all the stuff my parents bought me, now I got to pay higher taxes. I got to double my tax rate because all the stuff my parents bought me back then that I make a lot of that stuff I didn't really even need. It's building up. So that's kind of what they're doing. They're just dangling these carrots in front of you, not thinking, how's this going to get paid for? There's no cuts. There's no nothing. It's just more and more carrots dangling in front of you. And it is going to come to haunt us, folks. I promise you that. And I don't mean to keep beating the dead horse on the deficit, but it is going to be a big issue. And they're going to have to take care of it, because it's just going to continue to grow and grow and grow out of control. So that's I'm not trying to scare you, but that's that. What she was talking about is how strong the economy was. And I know I use this every day. So you go through here, and this just gives us some of the, couple features of what's going on right now in the economy. Inflation's kind of in line to a point of 2.2. And yes, it's not the 2% they wanted, but it's far cry from the 9% where we were. So a nice trajectory down. Okay, that's what you're seeing there. Unemployment rate was way up there. What is it, 14, 15%? Now it's down to rate in range of right around 4%. And this is what they were saying. Our GDP, our economy is growing and growing and growing. And even with these high rates. So they're like, okay, this looks good, that looks good, that looks good. Well, why cut rates? And that's what basically the markets are kind of at odds with that because of exactly that. And then you have investors all over the world, or countries all over the world, needing money. Okay, is China just their stimulus package? How do you think they're just going to print it? Well, they're going to issue bonds and things like that. So you have countries around the world flooding the debt markets, and you have investors sitting there just picking the highest qualities at the highest rates, yields that they can get. And that's why mortgage rates continue to go up and up and up, because they are riskier than U.S. bonds. And then you got to look at other countries' bonds in relation to our mortgage bonds scenario. So I'll keep you abreast of what's going on through this section here. But the good news right now is CME FedWatch tool's still telling us it went down a little bit, an 88% chance of a 25% rate cut at the next meeting. And that next meeting is not too far away. So that's our report for today. My name is Dan Frio. I'm actually a mortgage loan officer, and I'd love to win your business. Okay, I'm licensed in all 50 states as well as Puerto Rico. I can help you buy that first house, buy that second house, refinance the first house and pull money out to buy that second house, refinance, reverse mortgages, anything you need. I'd love to help you. How to get started? Well, first thing is if you go to our website, it's therateupdate.com. We just did a video. It was a live report, and I'll put that video right up through here. Okay, and it's going to explain to you guys how this grant finder works. It was a live event. We go through it and show you how the national grant program works and the Chicagoland grant works and the pros and cons of all this. So check that out. But if you want to just get the application going, or maybe just want to chat with somebody to see how we can help you, click the apply now button. In there, you can schedule an appointment, or you can actually scroll down and there's our 800 number. Just call us. There's usually 3 people online. I'm one of them. So there's going to be Alan, David, or myself most likely answering the phone. So just call us and let us know where you need help. The number is 844-775-5626. Or if you want to reach me personally, you can reach me at dan@therateupdate.com. So thanks so much for watching, guys. God bless. Have a fantastic night. Sorry it was a little bit lengthy than normal, but hopefully you learned something. And I'll be back tomorrow to show you how this mess starts all over again. So take care, folks. I'll see you tomorrow. Bye-bye.